You're running full speed, but the markets are faster. Quasar Markets Live brings the world's top financial minds to you. Everything you need to know in one place. Learn from elite educators and gain a competitive edge, leveling the playing field for you. Join the conversation. Quasar Markets Live.
Good afternoon, Quasar Markets Live. Here we go. We've got Michael LITT. Y'all love him. Y'all know what's going on. Look, Michael, the markets are a little crazy here, and I think, people are asking you on a daily basis now, what is going on? You've got some comments here. I know you and I have been talking in the pre-markets here a little bit about we have been discussing on three different levels. One, the geopolitical issue. Two, from a White House standpoint and how the people that are around Camelot are reacting. And number three, this trade war that's going on. So let's get to it. Tell me a little bit what your thoughts are, and let's go.
I was hoping somebody was going to explain it to me today, actually. I was going to stand back, but I guess not. Actually, you're right. I had a chance to speak at a couple of conferences, very large industry conferences, and people who are, expert in manufacturing industries, real estate industries. I love their micro touch with a lot of what's going on. It helps me think through things. But a lot of questions came up. Can you explain, is this a rally in a bear market, or is this a new bull market? Can you take me through how you think about deriving your view on this? And I thought, okay, well, why don't we do that? Why don't we? And I came up with a lot of the data. People said to me, which data? You've said to me, Steve, which data do you look at? So what I did was I pulled together a little PowerPoint here, and we're going to have a quick history lesson. And then we're going to go into making a case for one, a new bull market, or a rally in a bear market. But we're going to use our little history lesson to help us think through this. And I grabbed a quote from Mark Twain: "History doesn't repeat itself, but it does rhyme." Mm-hmm. So let's go into Stock Market History 101 on the next slide. Now, this is a required course for all our viewers. And so I went back and I remember a saleable rally. It hit me that back in 2000, when the dot-com peak was on March 10th for the NASDAQ at a little over 5,000. And then 2 weeks later, Friday, March 24th for the S&P 500. And look how long it took for those markets to recover, get back to those peaks. In fact, it was funny. In June of 2007, the S&P poked its head above 1527. It got to 1536, went back down with GFC, and didn't really get back to that level again until 2013. The first wave of the sell-off took the NASDAQ down 37% to 3205. And the S&P had kind of a garden variety correction there at 10%. Really, there was an interim bottom, May 26th. And then a really sharp rally occurred. And it was a saleable bear market rally. I remember it distinctly because, like everyone else, I was loaded up on Oracle, Microsoft, Sun Microsystems, and Xilinx. And I sold them in early July, late June, early July. And I took a little bit of a hit, but it wasn't that bad. I kind of went to the sidelines, and I remember that distinctly. By the end of the year, the NASDAQ was down 52%. That was that Bastille Day, July 14th, was a saleable bear market rally. By January 5th of, these are the numbers I was able to grab, you were down 52% and 15%. Again, S&P wasn't doing as bad, but what happened was the dot-com bust, when it bottomed out in September, late September of 2002, that NASDAQ was down 76%. And then the Valentine's Day, what I would call the second Valentine's Day massacre in February of 2003, the recession had taken the S&P down much further to 835. And so that was, I distinguish between the dot-com bottom and the recession bottom, right? And we have a little bit of that in play here. Keep this in the back of your mind in our history lesson, that we've got the mega cap component, and then we've got the potential recessionary effect of the administration's policies and the reaction from consumers and countries around the world. But I just put in here the GFC bottoms just so people could see for a perspective that the NASDAQ actually did not go below that 02 level. The S&P did. Its bottom was below that. And that's why we didn't get back to that 1527 on the S&P till 2013. Our recent peak, now shifting to February 19th of 2025, was 20,000, a little over 20,000 on the NASDAQ, 6144 on the S&P. Our April 8th interim bottom was down 24% on NASDAQ, 19 on S&P. S&P got hit harder because it is got a very high weighting to those mega cap stocks, and they got hit hard. We had other sectors like financials and industrials, utilities doing well, but the mega caps dragged that down. We've now, these are the numbers I grabbed yesterday on Cinco de Mayo. The rally has brought us to down 11%.
Mm-hmm.
Second, down 8% on the S&P 500. So the question is this like Bastille Day in 2000 when we have a saleable bear market rally? Or was April 8th a bottom that initiated a new bull market? And that's the question I want to answer. I want to come at it with a clean sheet of paper. So let's look at the next page, and we're going to make the case for a new bull market. Now, you don't hear many people talking about this, Stephen. How many people have started out telling you this is, I mean, at the inauguration, people were telling you that story. But in the last 2 weeks, how many times has somebody laid out a case for a new bull market to you?
Well, okay. I will say that Scott Bessent today told the House that the banking committee that he does not see a recession on this at all. No, there's nothing in the cards of a recession. So maybe he is telling you from the White House that they don't see this.
Mm-hmm. Well, Scott's been he's the one. He's certainly an A pick, a first round draft pick in that cabinet.
Yeah,
I've always said that, and he does have access to a lot of data. So let's make the bull market case then. So okay. Scott and I are two people out there making the bull market case. They're going to cut $163 billion in non-defense discretionary spending in 2025. That's a good thing. They're cutting it from education, science, and housing assistance. So they're taking it from kids, researchers, and the poor. Not exactly a Robin Hood strategy, but they are going to reduce the $6.5 trillion of government spending by $163 billion. Lower deficits due to additional revenues accruing from successful tariff negotiations with key trade partners, right? So now you're going to add to that. Global trade tilts in favor of the U.S., forcing China to move away from its neo-mercantilism economic structure. We talked about neo-mercantilism, right? And how it is not a sustainable model for fair trade. In fact, at one of the conferences I spoke at, a guy in the audience came after me and said, "You cannot disrespect China." And I kind of stood and I told him, in Chicago, we can say whatever we want. And the whole audience, or 2,600 people, just erupted. Elimination of taxes for those earning less than $150,000, tips and Social Security, increases consumer spending. Deregulation of the banks, housing, and energy. Bessent talked about that today to the House. Are going to accelerate economic growth. Confidence in lower deficits reduces U.S. government's borrowing costs and the projected debt service payments. And the Bretton Woods 3, which is what we're calling this new trade structure, the new role of the dollar, reduced reliance on the dollar, less dependence on the dollar, leads to a more sustainable global trade. Full stop. There's your bull case. Okay. And it's, I think that Bessent touched on a lot of this today, to your point.
He did, actually. Yes.
You know what I mean? He was talking about, I came up with this last night before he spoke, but these are kind of the high points. I'm reading between the lines on Besson. I kind of understand where he's going. He kind of kicks me back into the fairway on how he wants to articulate it. And he's become the spokesperson for this administration. Clearly, when was the last time you heard Lutnick out there in front of things like you've heard Besson? You haven't.
Zero, because I think they're hiding him.
Right. And they're having a lot of trouble with defense too. There's a lot of miscommunications and lack of coordination there. So they're kind of pushing that Hegseth back into the background, right? While they try to sort things out. They have.
Well, I think the question mark here is that he is Treasury Secretary, and he is the guy, the adult in the room that has been through this a lot. And so I think that he is probably the person that's probably the best to actually answer these questions, especially when it comes to the policies of the White House, since he's literally sitting inside the White House every day.
I think the difference between Trump's first term in office and this administration is that a lot of the policy decision making was coming from Paulson and Mnuchin and Tillerson, and then it was being discussed and agreed on what they would or wouldn't do. I think the policies are just streaming out, and Besson has to sort of deal with them, right? I think he fundamentally does believe in a lot of these as key objectives. And this is an extension of what we talked about a month and a half ago with what is the administration's.
But wouldn't you say from this administration to the last administration that his biggest difference outside of who he's picked as his cabinet, I would say that he wanted to put tariffs on, but he was a little bit more conservative when it came to actually presenting these plans. Whereas here it's a smash and grab, more sledgehammer politics, as I've been saying. Correct?
He was talked out of it by Paulson, Mnuchin, and Tillerson in the first administration. I think there's a not wanting that to happen and wanting to have people in this cabinet that will not stop that from happening. Yeah. And so what you describe as smash and grab is a result of there being nobody who will
say no to him,
prevent this this from happening. So yes, that's accurate. Okay. Let's start looking at the other case, or maybe not. Let's listen up to why that may not. We are seeing forward earnings guidance down sharply. I talked about the market, even after it corrected, not necessarily being cheap, because you were going to get big downward earnings revisions, and we're starting to get those. And forward guidance, this is essentially, we have not seen this kind of forward guidance deterioration since COVID.
But what would you say to the people who say, including myself, that a lot of companies are not giving any guidance, much less forward guidance?
Well, this is actually people giving downward guidance net. This is a net number of downward, upward, less downward. But if a company, and we haven't seen this kind of deterioration since COVID.
But if you see this many companies going, they're nervous or scared that they don't even give guidance because they know it's going to be down, right? Why would you not even give guidance?
Well, some companies do not have visibility. I think it was telling to me was some of the soft commentary, like McDonald's said that they thought there would be some consumer softening. They did not anticipate negative 3.5% comps, which is McDonald's is you want to talk about a big data set, right? That tells you a lot about the consumer. And I had mentioned Bear Burger in New York City, 34 units, had seen a $1 reduction in the average ticket, which means there's two things. You look at traffic and you look at what's the average ticket. $1 off a $26 or $27 ticket is a big deal. It means people are making decisions not to get an extra side or an extra drink. And it's telling. So Let's look at the next.
I would argue that in my case, it would be me eating less, right? Through some of the weight loss drugs too, as well. Would you say? No?
Maybe,
Okay.
but it's not 3.5%. McDonald's is telling you their customers, it'd be tough. ISM service inflation number came out. Yes, I think it was on Monday. It is a leading indicator. You can see the yellow line leading upwards when we have increases in inflation historically, right? And
Right.
it just punched up above that it's about 4.2% now. That's important. We're getting CPI, the white line still turning down because of rents. Rents are still falling. You've got rents falling in the Southeast, which got overbuilt. Austin's down, I don't know, 5 or 6% year over year. So OER, as you know, such a big part of PCE, big piece of CPI. That may mislead for a little while, but when you look at the PCE, when you look at inflationary expectations and ISM services inflation, you are seeing inflation creeping in, and this is a leading indicator right here. That's important, and it's not positive. That's why the bonds are trading at 435, or the 10 years trading at 435. It's not trading down. It may not be able to give you relief if Scott is wrong and we do get a recession.
And we're 4.31 now. But does this portend to tell because I mean, obviously tomorrow's a big deal for the FOMC about rate hikes.
It'd be interesting to what a negative in this conversation, the FOMC, could be that it looks like inflationary expectations are becoming untethered. Look for that. I'm seeing it. Look, $163 billion in cuts, but we have $4.6 trillion in transfer payments. Those are Social Security, Medicare, and local government transfer payments, which are for education, infrastructure, highway, roads, infrastructure building. And the third component of that local government transfer is very, very, very poor, especially the elderly poor, who need the lowest level of like a state home to live in at the end of their life, right?
And you're hearing from this White House that they're going to cut back on some of this stuff, correct?
Again, as I said up front, the press secretary, it was almost like I didn't intend to drop the mic, but I did. Yeah, we're taking it away from kids, our research scientists, and the poor, the very poor elderly. Housing assistance like this, like the lowest form of you share a room at a very low cost, low budget kind of rest home, or where you need some medical care, but yeah, you're talking about you're taking it from those who can't fight back, I guess. But this isn't going away. And here's why: because our population over 65 is growing. This peaks, this gets to 20%. It's at like 17.5. It gets to 20% by 2030. We still have the baby boomers and the fact that we're living longer impacting those transfer payments. It's not going away. We are in the same situation Japan has been for about 10 to 15 years longer than us. That's the reality of this situation. It's not a revenue problem. These are, we increased our revenues from 3.7 trillion in 2020 up to 5.2 trillion in 2024. And the reason we did, so it's not a revenue generation. It's not the revenues we're getting on taxes. It is largely that demographic issue. And we've talked about that before.
So you're saying that the reason that we're having these issues is because the aging of the population, and you're saying revenue is coming in fine, everything's good there, but it's the payouts from Social Security, and we're not taking enough money out of Doge and things of that nature, right? The addition is not happening here.
No, I don't think that it maybe you could say unless you restructure the deal with Social Security, Medicare, and cap medical costs in the United States, which is hard to do. So, okay, that's like Nixon's whip inflation now, price controls. That doesn't work, right? None of that works. The demographic reality is what we saw. Where we were winning was on this revenue generation. So let's see why we were winning in the next slide. And it's because we had low unemployment. The bulk of the tax revenues for the US come from wages and earned income. I mean, we pay individuals, not corporations. Corporations don't pay a lot in taxes in the United States. It hasn't been our tax policy. It's been a very good tax policy because it's led to a lot of investment and growth in the private sector, and it's created this very, very low unemployment rate. And that low unemployment rate generated that growth from 3.7 to 5.2 trillion. That's probably our best bet. That's the player we should hand the ball to, because keeping the economy going, keeping unemployment and inflation low, the Goldilocks economy.
Yeah, but you hear the Fed say that we have a dual mandate. We got to keep, obviously it's unemployment and labor, and it's also the rates. I mean, I get all of that, but we're starting to see unemployment creeping up. We're starting to see jobs being lost, and we're starting to see an aging population. So, okay, so answer your question: is this a bear market rally or is this a bull market?
Well, this is the case for the bear. This is a bear market rally, because if that unemployment number goes up because of the administration's policies don't deliver what was on the bull market case, right? If elements of that fail to materialize, there is going to be collateral damage that's going to raise this unemployment rate and reduce that growth in revenues. Okay, we need growth in those tax revenues at the same tax rate. But because we have people who are fully employed and getting what we've been seeing over the last 4 years, which we did not see from 2010 to 2020, is wage gains, real wage gains above the level of inflation, Stephen. We need a decade of that to get ahead of this thing.
And of course, with this slide here, you're saying that, interest rates payments now are going up because of rates. So is this another reason why the Fed should cut rates then?
Well, one thing that, no, I'm not going to say that. But what I'm going to say is this did jump up because the Fed is trying to normalize rates. I don't think the Fed should stop trying to normalize rates. We should not go back to QE and rates that subsidize, interest rate policies that subsidize some bad policy decisions like we made with the mortgage that created the mortgage crisis, trying to get too many people into housing that couldn't afford to pay mortgages. And here's the problem with recession, Steve, right? If we try to cut that interest payment by putting the economy into a recession, we save $568 billion in interest payments. That's assuming
which is 4 times the size of what Doge has saved. So it's like, just cut the rates.
That's great.
Right?
But guess what happens to that $5.2 trillion revenue line? We lose $1.284 trillion. We're $725 billion worse off. So you cannot solve the problem with a recession. In fact, if you're going to take one slide and say, what really underpins that this is a rally in a bear market, it's the fact that the probability of this has increased.
But Bassett just said today, no chance of recession. He sees nothing in the data to say recession, even though we saw 0.3 minus 0.3% of the GDP. He said nothing's showing the recession coming up. Is that correct or not?
Since I don't work for anybody, I only work for myself, I can say the probability of this scenario on this slide has increased.
By how much?
Let's see why. Let's look. Let's go to the next slide. Remember, everybody's you're into the data room with me here, right? we're looking at what I'm thinking about. The cost of borrowing has been going up
Yeah.
because, in part, because the term premium is rising, right? The term premium, we're getting a positively sloped yield curve because to borrow money for a longer period of time, you usually have to pay a little bit of a premium for the inflation risk, the risk that the entity won't pay it back. That should be very little with the US Treasury, but it's been going up. It's been normalizing. Why has it been normalizing? It does raise the cost of borrowing money for longer periods of time, which is what we should be doing with our deficit. Let's look at the next slide. Okay. It's been going up because the Fed's been shrinking its balance sheet. It's trying to normalize not only its interest rate policy, but the size of its balance sheet. It's gotten it down from 9 trillion down to 6.7 trillion. It's important for the Fed to get its balance sheet right size,
Okay, so
that
should
it
the
has
Fed
flexibility
pause?
in a crisis. It needs flexibility in a crisis to be able to buy bonds.
Right. But so are you saying that the Fed should pause? That could be their big sledgehammer then themselves.
I don't think they want to pause. They've feathered it. They've slowed the rate at which they're letting the assets run off. These are maturities. These are
Correct.
mortgages and treasuries that are maturing, and they're not just they're reinvesting less. So right now, they're trying to get down to, I think, nobody knows exactly. A lot of smart people think it's 5 trillion, a little bit above where they had based it. You could see where they flattened it out in the 14 to 19 period. So it'd be 5 trillion, but they're trying to feather that down over, say, a 3-year period. That normalizes that term premium of interest
And
rates.
it seems
Because the
like
Fed's
every
not
time
out there buying bonds, right?
And every time we see a big shoot up is during some recession, COVID, in this case, .com bubble here, in this
Correct.
case,
And they
COVID.
need that flexibility to react to a real crisis. So they're trying to get themselves in position and give themselves flexibility. They should continue to do that. They should normalize interest rate policy. There's nothing about the world on January 1st of 2025 that would have not told you that the Fed should continue to move towards policy normalization. Now, we see investment grade spreads widening. Okay. That increases the cost of funding. Okay. That doesn't put wind in the sails of the economy. It's not so high right now that it's problematic. These are normal. In fact, some people would argue borrowing spreads are still below average, slightly below average. Let's look at high yield spreads too on the next slide. And I'll tell you something. I talked to the high yield guys and some private credit guys. These cats are nervous. They are glad they manage other people's money. They really don't love putting money out in front of an increasing probability of a recession, because what happens to high yield is it gets murdered. You see higher default rates, less liquidity. It really becomes subject to a.
And then let's explain that to people too, as well as risk. As recession happens, people want less risk, so they aren't feeling as well as they'll buy those junkyard bonds, as I always call them, or high yield.
Get the big spreads, get the extra four. Here you're getting extra 370 base, 375, 3.75% more yield.
Some of those high yields are like Chicago teachers, things like that. They're paying 9%. Are a lot of these places in trouble too then as well?
Well, when things sell off in high yield land, there just aren't a lot of buyers, right? They that's why high yield.
The people that need those because they're having to raise their rates still need the money, right?
Yeah, so some people have to pay very high rates, and that does induce that heightens the depth of a recession. I don't think we're going in with excessively high borrowing, but high yield spreads have been low, and when they widen, it's going to hurt some businesses. And spreads could blow out. These cats are nervous about
what sector
money here.
What sector will hurt?
Well, just private equity generally. I mean, you wouldn't be able to get the exits would, become much more difficult because you can't sell to another private equity and re-leverage the thing. You need to go public in the equity markets. Your balance sheet condition and your cost of capital probably wouldn't allow you to do that at a favorable price. So you really get some gum in the gears here. Again, that looks vulnerable to me. Now, remember, the good news is our household debt service is manageable because the households got religion after GFC there in 08 when they had a high debt service to disposable income. They brought it way down. It only went up a little bit here because of interest rates, but even now it's very manageable. This is the one thing that's going to hold us back from a GFC type because the consumer is in good shape now. Let's keep going, though. He's in good shape, and he's important. However, what just happened to consumer expectations about unemployment? Again, folks, this is what I'm thinking about as I'm going through whether this is a new bull market or a sellable rally in a bear market. We have very high and increasing expectations for unemployment over the 4 months in a row. It's gotten up. And what's really interesting is it's gotten up there with GFC and that 2000-2001 scenario we looked at earlier. This is not something to ignore. This is important information, right? Why would the consumer be expecting unemployment to go up that high, right? Here's what I think. I think that the consumer knows that even if we get just a 10% tariff, which is what LITT said they want, because they want that tariff money to reduce the deficit. They want to charge foreign producers, importers, for access to the U.S. consumer, the $20 trillion U.S. consumer. They think they can get it. But if you just charge, let's say they work everything out with China. Bessent said today we have not started negotiations with China. He said that.
He did.
That somebody else said something else 2 weeks ago, and Bessent squared, kind of leveled the playing field and was honest about it today. And I give him credit for that. You charge a 10% tariff. Let's say we get to a 10% tariff with China and who we haven't started a conversation with, everybody. Well, that's 10% at the port. Do you think when that item gets to the shelf that you're going to pay a 10% increase in the price, Stephen, or are you going to pay more than that?
Right.
There are people in the middle who have to deploy capital,
right,
working capital, and then they have a markup, and it's probably closer to 15 or 25% increase in the price.
Yeah. That
is, if you think about a sales tax, you hate paying a 5% sales tax or a 7% sales tax. Or if you're in a ski resort, you pay a 8% or 9%, right? And you're kind of like, God, I really hated paying that sales tax, right? Think about a 25% sales tax on everything across the country. I think people are starting to understand how large this tax increase. It's a consumption tax. It's like that.
Is it all because of tariffs? Is it all because of tariffs?
73% of companies said they were going to increase prices. 25% said they were going to decrease margins. And the balance of 2% gets paid by the producer.
Okay.
This is why I believe the consumers actually, as a group, is somewhat intelligent and why they're expecting this increase.
Is that why I'm seeing when I go to the mall and I see a huge number of people at the mall because they're front running the problems here?
Yes, that's what happened with inventories. That's why that was part of the GDP report, was the high imports and inventory stocking, which is a subtraction. We talked about this last time. That's why GDP was negative last week. That's coming down. Port of Los Angeles is down 35%. Containers arriving. Port of Long Beach is down 44%. We're seeing it at the ports now. So what happened is the inventory stocking's over. Now you're getting the decline in items and containers arriving at the United States. All right, let's look. $300 billion industry. Statue of Liberty visits down 6% in April.
Ooh.
Forward bookings for New York hotels, which has the largest international travel destination. Every month you look out, I looked at every month, July, August, September, October, November, December, down 19 to 22%.
Yeah, it's a good point. I just was booking a hotel near in the FiDi in the financial district, and I was about to swallow because I knew I had to go. $300 to be down the FiDi at a Hilton. Like, what?
Yeah, if they're getting 10 to 20% forward booking reductions, then you are absolutely looking at that. I saw an estimate that this. And you only have the bulk of these people come in the summer. They don't come in the winter. It really drops off. They're thinking this industry is going to lose $90 billion in sales. That's hotels. That's
90 billion out of 300 billion.
Statue of Liberty down 6% in April. It's going to probably be down. If hotel bookings are down 10 to 20% in New York City, you can assume that Statue of Liberty and all the people who work in travel and leisure, right?
They lose their jobs.
Well, you're going to see that. McDonald's, like I said, down 3.5%. Consumers, let's look at the next one, which is, the consumer's sending up a signal flare. Retail and dining visits are falling for major retail chains and restaurants, right? You're seeing the year-over-year deterioration.
Why is retail only down 0.5%? Because you see it's mostly matching.
People are actually out buying things. And they're buying things in front of the tariffs.
Right.
There was inventory stocking by businesses. Now you're seeing purchases before the prices go up. It'll hold up and then it won't. That's what I think is going on. I think.
When will it not hold up? I mean, I looked the other day. I saw it at like I said, Sam's Club. I saw an 85-inch QLED TV, $500. Like, I paid $2,000 like a few years ago. Yeah, it's a change, but oh my goodness.
I think when prices go up, then demand's going to respond, and I think it's going to be in the third quarter. Because you're already seeing it. They're sending up a signal flare here with this one. Real estate expectations coming into this year. 88% of this was Deloitte who did this survey. 88% of the commercial real estate businesses thought they were going to see increasing revenues in 2025. This was done in the fourth quarter of 24. So whenever you have an industry that has high expectations and those expectations are not met, it's kind of like a very tall tree falling. It has farther to fall. So,
do you know what the thought was behind Deloitte thinking that expectations were going to be way higher?
Well, they're just doing the survey, but this is their survey results where you had deterioration in commercial real estate revenues going for 3 years in a row. It was
and the thought behind it was we're catching up from COVID and back to work kind of thing.
I think they thought conditions were going to improve. Interest rates were coming down. Remember, interest rates coming down. They really need to refinance a lot of buildings, Steve, and they kicked the can down the road. A lot of buildings had equity infusions to get refinanced. I'm not sure with the inflation, the ISM surveys, and what we may hear from the Fed tomorrow about inflation starting to become unanchored. I'm not sure, and those spread widening and that risk premium, forward risk premium in the curve as the Fed shrinks its balance sheet. I'm not sure they're going to get interest rates a lot lower for commercial real estate refinancings. That means people are going to have to put more equity into the deals. I'm not sure some deals are going to be able to raise more equity. So you're going to have distressed real estate in 26 and 27 may be a very interesting place to invest, because in an inflationary environment where you have this huge tax increase and you have consumption demand destruction, commercial real estate actually does have a very positive correlation to inflation. So I'd want to be a buyer into. I'd want to start thinking about, if I'm a big asset allocator, distressed real estate, because that expectation is not going to be met, and there's going to be a lot of disappointment. Interest rate,
even with people like myself who will never go back to. I mean, I'll never want to go back to an office, right? That's a whole thing, right?
Well, we've changed the work habits, and I watched that data from the key card, the Castle key card data, and it's flat. It goes up a little bit, but it's not going back to where it was in 2019. People's arrangement, their understanding at work is different. Commercial real estate, there was a big surge when they drew those loans down in 22 at the old rates. Now it's flattened for the last few years. If we go into a recession, that's going to turn down. They're not as steeply as it did in 08 to 2012, but you're going to get a downturn. And that's where there's going to be a buying opportunity, just as there was in that 2010 to 2013 timeframe. I'd like to anticipate that as an allocator investor. There are public.
All right. So how would you invest then?
Well, you want to look for it's really distressed and opportunistic real estate investing.
Do you have a time frame for us?
I would say that you want to buy into late 26 and 27 because it's that far out, but because it's a slow moving train. But I just don't think
should we be shorting REITs right now?
Depends. Yeah. I mean, look, again, this is the argument that this is a bear market rally that we're looking at. Okay. And I would include that sector. The nation's wealth depends on the value of its currency. And as I said 2 weeks ago, and as I said 4 weeks ago, the dollar is hanging up. I talked to some really smart emerging markets people in Asia, and the notion that American exceptionalism has peaked and is now in a deteriorating state is actually a common theme in financial circles from Singapore to Saigon to Tokyo, Busan. People over in Asia really think that on a lot of levels, the United States has sort of abrogated its position in the world on a lot of fronts. And I think it's reflected. I'm looking at emerging markets and European equity funds that are doing very well this year, Steve. Yeah. Up 14%, up. I have an emerging market fund that's 20, really now up on the year, and there's a lot of money. It's like stuffing 15 pounds of rice in a 5-pound bag. Prices shoot up over there when money gets diverted from the U.S. markets, the U.S. dollar, into those markets because the liquidity isn't as great. So the prices can shoot up rather quickly, as they can in small cap stocks as well, Stephen. Mm-hmm. Europe, same thing. I think you get a big reaction. This is what really worries me. If what people are openly discussing in Asia is true, and I talked to a guy who used to be on the management committee at Morgan Stanley, really smart guy, and I put forth my foreign direct investment into the United States could flatten out or actually drop. And he said he thinks this is the biggest risk for the U.S. markets. If this turns over because of this policy mix the administration has chosen to pursue to try and achieve those goals we laid out in the bull market case, and it doesn't work, this could turn over.
But it seems that, according to this chart, that foreign investment is still coming into the United States, correct?
It has been. This has driven American exceptionalism. This money that comes into the United States, we run a trade deficit. They reinvest the money here. We earn very high rates of return on it, and our wealth as a country increases enormously. And this is the percentage of the markets they own. They own 20% of the equity market, 30% of the treasury market, and 30% of the corporate bond market. They're very large investors in real estate in the United States. as well as private equity and venture capital, growth capital. If that foreign direct investment turns over, then multiples on the stock market come down. Forward expectations on growth come down.
Yes, but if our dollar comes down, right, that's their buying power is going to be stronger. So why wouldn't they be looking at U.S. equities a little stronger?
No, I think they're looking at the dollar being in a 3 to 5 year bear market.
Oof. Okay.
Okay. I mean, this is if the policies are going to last for 4 years, they're not going to stick around, and you're going to start to see the momentum capital shifting into the markets where money is moving, and it's those other markets that are performing. A lot of what I've laid out here from a data perspective tells me that Scott was perhaps talking the administration's book today. I think the risk of a recession is much higher. I think the risk of the Fed also noticing that inflation expectations have become unanchored. The dollar, I saw a chart today. I don't have it in here, but I saw it this morning after I sent this to you. Usually the 5-year differential on rates is a good predictor of where the currencies trade. That the 5-year rate where it is in the US today would attract capital and attract investment. It's not.
What's the difference?
The difference is that I think people are looking to put money to work outside the United States, both invest. Well, clearly it's starting everywhere. Everywhere that there isn't this uncertainty created by tariffs that are of unknown magnitude and a consumer who is going to have to pay them. Producers, if the consumer pays it, then the consumer can buy fewer units of whatever they're going to buy.
Okay, so over the weekend, we had a nice chat with Mr. Warren Buffett. I got to hear him talk about it. He sits on $384 billion of cash, which he said he's going to be gone by January of next year, at the end of this year. Greg Abel was asked, they asked if Greg Abel, the question was, are you holding this cash for Greg Abel, your successor? He said no. So where would a Warren Buffett in your hypothesis here of the dollar for an investment, where would you be if you were a Warren Buffett putting your money to work and buying something?
I don't think Warren Buffett is holding $360 billion of cash because he thinks we're in a new bull market.
Okay.
How about that?
So where does he
I think he sees
he's been buying Japanese stock houses, right? He's been buying those.
He's a patient investor, but I
think he doesn't have much longer to go at 96, and he said he's not giving the money to Greg Abel. So where is his patience going to have to land somewhere?
I think he's going to play the game the way he's always played the game. I don't think he's going to change what he would otherwise do. He has all that cash because he sees he doesn't know how much damage, but he sees damage, and he also is. He's a value investor. He's a Ben Graham guy. There's going to be great value eventually here, but I think the answer is this is a sellable rally in a bear market, and I think that the points that I made earlier and it's going to take time to see all of this playing out.
Where is capitulation? Where is it where people just feel like they're hurt so badly they just feel like they got to be back in the markets? And this is it. I mean, you're scaring me so much. I'm thinking about pulling everything out. You already kind of did, didn't you?
Yeah, back in February when I said I went to 50% cash. I kept my European stocks. I kept my emerging markets. I got beat up. I probably should have bought more gold. I kept my value manager. More of an S&P 493 mid-cap guy. Stephen, it's not easy to time these things. You couldn't have predicted that July 14th of 2000 was going to be the peak saleable moment in the equity markets. And you couldn't have known how deep the markets we're going to go down after that. I don't think anybody felt it was going to get as bad as it did, nor did they during GFC.
Mhm.
There's so many actions on the part of the administration and corporations in terms of their expansion plans, their spending, their reaction. How is the consumer going to react to a 25% increase on a product?
And if you ask that question, you said earlier, the Fed has its own bazooka, right? I think that's what we said in the previous administration. They had a bazooka. But their balance sheet's pretty heavy, tight right now, and they're not really weaning it off that much. Is there room on that balance sheet? I mean, Scott Bessent said we'll never go bankrupt because we can always print more money. That doesn't seem like good policy to me.
Well, by the way, that'll send the dollar down. And the wealth of your nation
Right.
is your currency measures the wealth of your nation. That's printing money is not the answer. And we saw what happened when Powell's job and the Fed's independence was threatened. That's when we got a couple wheels over the cliff and they had to pull back. Okay. So trying to force, if the administration's game plan is to force the Fed to pursue monetary policy that's going to enable the administration's fiscal policy and their trade policies, I think that would further increase the likelihood we are in a bear market and would increase the depth of the bear market. Those are not good scenarios. That's what Japan had to do, was buy its own debt. And you went into, a couple lost decades there. You don't want that, Stephen. That
Right
is not
after-
a scenario we want to see. I've said that before.
Yeah, you
I'll
have.
say it again. The Fed should be normalizing interest rate policy, shrinking its balance sheet. There's no reason for any of this to have been. And the question is, if we haven't started conversations with China, they're going to have to pivot and try something different, whether they end up with egg in their face or not, because that kind of tax burden on this consumer is going to slow the economy radically. It's going to change behavior, because remember, the second order function on all this is investor behavior and consumer behavior. And if they're both pulling their horns simultaneously.
Trump said right after he was elected that he didn't want to be Herbert Hoover, but it seems like we're going right into these numbers.
It's interesting. I talked about this, and I don't know if I mentioned it on one of our discussions, but I've been talking to people about, we're going to shift from this culture of consumption and to minimalism. We're going to go from materialism to minimalism. And Trump said something yesterday where he used the word austerity. We're going to have to live with some austerity. And it was the first time he said anything like that. But we're going to have to fix things. We're going to have to make old things work, because we may not be able to buy the part for it or the thing.
AutoZone, those companies that
too much.
The car up. Yeah.
A minimalist kind of environment is not what anybody had in mind. It doesn't mean you pay high multiples for growth, right? It really is interesting culturally if this country is asked to pivot to a minimalist kind of mantra from a materialist mantra. And it has quite a lot of impact on both the consumer and the price of financial assets that are dependent on growth.
And you said yourself, dollar will be in a 3-year bear market. Is that where our bear market's going to last 3 years?
Look, unless things really change, then trade and investment capital, and if foreign direct investment actually flattens and turns down, then definitely that's going to come to pass.
Wow. Michael Litt, thanks for The Sky is Falling today. I appreciate that. But
hey, we started out with the question was, is this a new bull market or is this a rally in a bear market? And the data is telling me, now, all that stuff I laid out earlier could come to pass, but me sitting here is telling you oh yeah, we're going to cut a great trade deal that's going to be in our favor, and we're going to have higher growth and more access to China.
Yeah.
We haven't even started conversations with China.
All right. So this is a rally in a bear market.
How can I bet risk capital on that scenario, given what he told us? Now, he told us he doesn't believe there's going to be a recession. The data is telling me that the probability of a recession is increasing.
How much?
It's increasing. It's increased because of the data. Now, let's see what the Fed says tomorrow about inflation and whether it remains anchored or not. I want to hear what they say on that point.
And your first comment was from a quote from Mark Twain: "History doesn't repeat itself, but it rhymes." Tell me when another period was like this.
Well, the shock element we talked about last time with the Arab oil embargo. I don't think this is like GFC or .com necessarily. It's hard to find a period in time when you've had a tax, a consumption tax. That's how it's going to play. That's how it's effectively going to play out. That gets implemented on a surprise basis. A consumption tax of this magnitude is just, I'm not sure we have.
And I think with that consumption tax, I think it's going to force people to be minimalistic. They don't really want to be, but it's going to force them. Is that what you're saying?
It's like, yeah. Now we go from materialistic to minimalist. How do we think about the value of different secure? I want to own value stocks in that environment.
And let's talk about that in 2 weeks, Michael. We'll have you back.
I want high quality. I want value. I want yield. You know what I mean? The price of growth will eventually be something I want to own.
Are you selling the last bit of your 50% that you still own your stocks?
I'm going to hold the emerging markets. I'm going to hold the European value managers, European managers, some of the high grade bank loan stuff that doesn't. I mean, I earned 7% on, or 6.5 instead of whatever, 4.25 in the money market, but it's high grade. Again, I think that there are some assets that could be very exposed. I think you may be looking at a saleable. People who said, why didn't you tell me in February to sell? Maybe this is the saleable rally if the data that I went through and my interpretation of it appeals to the viewer. But they may buy the bull market case that we laid out as well. You choose. There's two sides to this coin.
There is a sellable rally according to Michael Litt. All right, Michael, we'll see you in 2 weeks. So I look forward to the next one because I definitely want to hear about where the markets is after Powell speaks and they have a boxing match, I think, at some point in DC. All right, Michael.
That's going to solve everything, but good luck to everyone out there on your investing, and we'll talk again in a few weeks.